The Federal Reserve just cut interest rates again, the latest in a series of cuts aimed at supporting a slowing economy and easing borrowing conditions across the entire financial system. For commercial real estate investors, CRE investors, both institutional and retail investors, this moment isn't just a headline, it's a decision point. Rate cuts ripple through every layer of CRE, from cap rates and valuations to tenant demand to fund level returns and investor allocations. Today, we're breaking down what smart capital does next and why this environment matters, especially for shopping center real estate and for investors evaluating opportunities within our strategy at Rockstep Capital. Let's start with the basics. When the Fed cuts the federal funds rate, most recently lowering it into the 3.5% to 3.75% range, the lowest level in roughly 3 years. It directly reduces short-term borrowing costs in the banking system. But here's the nuance. The Fed doesn't control the interest rate CRE investors borrow at. What they do influence is short-term base rates, which feed into SOFR, prime, and CRE loan pricing, investor expectations about future economic conditions, Treasury yields, indirectly, which shape long-term CRE debt costs and cap rate trends. What's the translation? Debt becomes cheaper. Capital becomes more active. Risk appetite increases, and asset values often begin to rise before lenders and appraisers fully adjust. This is why rate cuts tend to unlock transaction volume in CRE, something the market has been waiting for since 2022. So how do rate cuts change investment behavior?